Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, Professor of Economics at the Catholic University of Korea. Professor Yang, good afternoon. Thank you as always for coming on the program.
Happy to be here.
Well, let's start on Wall Street, where stocks closed a bit lower overnight, even as the Federal Reserve, as expected, went with a 50 basis point rate hike in its last meeting of the year. Chairman Powell saying they've still got a ways to go on tightening. The Nasdaq down about 0.75%. What's the story in the global markets?
Well, all three indices fell down by 0.42%, S&P by 0.61%, and Nasdaq, as you mentioned, by about 0.76%. But on Monday and Tuesday U.S. time, the market actually rose because they did not expect the Fed to take this hawkish position. So if we compare the indices at the end of last week, Friday, with indices numbers today, the numbers are still a bit up compared to last Friday. Now, I think this just shows the volatile nature of the market because on Friday they had a big drop. So if you compare the today's numbers to last Thursday's numbers, it is smaller. But volatility seems to be coming not necessarily from a mixed signals from the Fed, but rather over optimism or over pessimism by the market. And the reason that I'm seeing this is that the Fed did raise the rates by 0.50 percentage points to 4.5%, and this move was really widely expected. And in addition, the Fed members, including Chairman Powell, had emphasized that compared to September, the rates would be higher than expected, and the rate increase would be longer than expected. He's been consistently saying this for the last 6 weeks or so. But because the U.S. had slightly better than expected inflation numbers the day before the Fed announcement, I think the market got too optimistic. The inflation numbers that were revealed on Tuesday U.S. time, the headline inflation for November over 12 months was 7.1%. That was slightly lower than expected. And for just the month of November, it was 0.1%, substantially down from 0.4% that we saw in October. And if they maintain the 0.1 monthly rate, that actually brings the annual inflation rate below the Fed target of 2%. The core inflation, it was 6.0% over 12 months, 0.2% over the month of November. So that's actually somewhat higher than the 2% Fed's goal if that 0.2% is annualized. But I think this is the factor where the Fed was very worried about. If you look at service inflation, that's 6.8% over 12 months and 0.4%, and for the month of November. And the reason that this service inflation is very important is that it nets out a lot of other things and looks mostly at labor costs. So it does show that there is some momentum behind the current inflation, and that is, I think, behind Fed's decision why they want to keep up the rate higher and longer than they expected in September. For the Asian market, all three markets, Nikkei, Hang Seng, and Shanghai are down today. China reported weaker than expected retail sales. Japan, they had higher than expected exports, but also higher than expected trade deficit. For European stocks, they just started trading today. Only FTSE is trading right now. It's in the negative. Yesterday, DAX, CAC, and FTSE were in the slightly negative range. The European Union Central Bank is also expected to meet this week, and they're expected to raise their rates by 50 basis points. A bit of a good news for the United Kingdom. Their inflation eased from a 41-year high of 11.1% to 10.7%. So hopefully their inflation has peaked as well.
Well, here in Korea, an outsized decline for stocks today. The KOSPI falling to around 2360 by the end of the session. All the biggest names were lower, including tech giants Naver and Kakao, around 5% or so for them. Tell us about the domestic market.
Okay, well, KOSPI, as you mentioned, it's down 1.6%, and it ended today at 2,360.96. KOSDAQ went down 0.87%. It ended today at 722.68. For both indices, individuals bought, institutions and foreigners sold, and perhaps most sensitivity right now, Korean won has depreciated by 0.42%, or it went up by 5.51 to end the day above the 1,300 per dollar. It ended today at 1,303.51 per dollar. And obviously, this is because of the U.S. rate hike. The policy interest rate, as we mentioned in the last story, is now 1.25%. That is now large enough so that people are getting very concerned about it. The lower stock market today seems to be driven by foreigners selling Korean stocks, and the announcement by Chairman Powell was also accompanied by a press conference where he said that rates are not likely to fall next year. And this is actually consistent with what he has been saying for the last couple of months. But I think the market finally realizes this. And what the Korean market recognizes is that if the U.S. will not lower their interest rate, Korea will probably not lower its interest rate either. So we're in for a very high interest rate for the entire year, next year perhaps.
Well, let's stick with that theme. Looking at the big picture, the Bank of Korea saying this week's decision was in line with expectations, but warning there could be a return to volatility in the financial markets, depending what happens with inflation, for one thing, in major markets, other issues as well. They also said they'll take action if necessary. What do you make of the situation for Korea in terms of the global environment?
Well, the concerning factor is the large interest rate gap differential between Korea and U.S., 1.25%. And previously, there were concerns that that might cause a rapid depreciation of the Korean won. We had a bit of that experience in September, and the interest rate differential is actually now higher. So luckily, the Korean won market seems to be stable. Now, if Korean won continues to depreciate, but depreciate slowly, then Korean economy can handle it. What it cannot handle is a continual rapid depreciation like we saw during September and October. And the variables I think we need to watch out for the United States is core inflation and the service inflation rates, and the unemployment rate and the wage increases. For Korea, we need to look at the exchange rate, core inflation and employment rates, and growth rates, especially consumption, exports, and current accounts. Now, the Bank of Korea will next meet in January, and they will have to make a decision on what to do with the exchange rates. They're going to have three basic choices. First, if they want to maintain stability in the exchange rate, and control inflation as well, then they're going to have to raise the rates very quickly, match the U.S. increases as much as possible. Their second choice is just keep an eye on inflation. That means Bank of Korea will have to raise the rates, but it doesn't have to raise the rates as quickly as the United States because Korea has a lower inflation figure. I think this is what most people are expecting. The U.S. raised the rates by 50 basis points, so Korea will raise the rates by 25 basis points. Another possibility, though very low, is if Korean growth becomes too low, and unemployment starts rising very quickly. Bank of Korea does have a choice to hold the rate or maybe even cut it, but that doesn't seem to be very likely at the moment. Currently, other than the currency markets, other than the exchange rates, the next biggest concern is probably the bond markets with the lack of funds. That seems to be easing somewhat, but if the interest rate keeps on rising, companies may have more interest payment burden, and the bond market may get too jittery. So that's another area where we should keep an eye on right now.
All right, and we will keep an eye on it with your help, Professor. Let's leave it there for today, though. Thank you, as always, for coming on the program. Really appreciate it.
Thank you.